start by understanding what bilateral trade agreements are. In simple terms, a bilateral trade agreement is a deal between two countries that outlines how they will trade with each other. These agreements are designed to promote trade by reducing or eliminating tariffs, import quotas, and export restraints. The goal is to make it easier and more profitable for both countries to exchange goods and services. Bilateral agreements can cover a wide range of topics, from agricultural products to technology and services. By focusing on just two countries, these agreements can be tailored to meet specific needs and interests, making them a flexible tool in international trade. Countries enter into bilateral trade agreements for several reasons. One of the main motivations is to boost economic growth by opening up new markets for their products. These agreements can also help countries secure better terms than they might get in larger multilateral deals. Additionally, bilateral agreements allow countries to address specific issues, such as labor standards or environmental protections, that are important to them. By negotiating directly, countries can build stronger economic ties and foster closer political relationships. Ultimately, these agreements are about creating win-win situations that benefit both sides. Bilateral trade agreements typically include several key features. First, they often reduce or eliminate tariffs, making goods cheaper for consumers and businesses. Second, they may set rules for how products are labeled, tested, or certified, ensuring safety and quality. Third, these agreements can include provisions for protecting intellectual property, such as patents and copyrights. They might also address issues like investment, dispute resolution, and labor rights. By covering these areas, bilateral agreements create a predictable and stable environment for trade, which encourages investment and innovation. One of the most important aspects of bilateral trade agreements is the reduction or elimination of tariffs and quotas. Tariffs are taxes on imported goods, while quotas limit the amount of a product that can be imported. By lowering these barriers, countries make it easier and cheaper to trade with each other. This can lead to lower prices for consumers and increased sales for businesses. However, removing tariffs and quotas can also create challenges for domestic industries that face increased competition from foreign products. Bilateral trade agreements often focus on improving market access. This means making it easier for companies from both countries to sell their goods and services in each other's markets. Improved market access can lead to more choices for consumers and new opportunities for businesses. It can also encourage companies to become more competitive and innovative. By opening up markets, these agreements help drive economic growth and create jobs. Another important feature of bilateral trade agreements is the rules of origin. These rules determine which products qualify for the benefits of the agreement. For example, a product might need to be mostly made in one of the two countries to get reduced tariffs. Rules of origin help prevent companies from routing products through third countries to take advantage of lower tariffs. They ensure that the benefits of the agreement go to the intended countries and industry. Protecting intellectual property is a common element in bilateral trade agreements. These provisions ensure that inventions, trademarks, and creative works are safeguarded in both countries. Strong intellectual property protections encourage innovation by giving creators and businesses confidence that their ideas will not be stolen or copied without permission. This is especially important in industries like technology, pharmaceuticals, and entertainment, where intellectual property is a key asset. Bilateral trade agreements often include rules about investment. These provisions are designed to protect investors from both countries and create a stable environment for investment. For example, they might guarantee that investors will be treated fairly and that their assets will not be expropriated without compensation. By providing clear rules, these agreements encourage more investment, which can lead to economic growth and job creation. Dispute resolution mechanisms are a key part of bilateral trade agreements. These mechanisms provide a way for countries to resolve disagreements about how the agreement is being implemented. They might include consultations, mediation, or arbitration. Having a clear process for resolving disputes helps prevent conflicts from escalating and ensures that both countries stick to the terms of the agreement. This stability is important for businesses and investors. Many modern bilateral trade agreements include provisions related to labor standards and environmental protection. These rules are designed to ensure that increased trade does not come at the expense of workers' rights or the environment. For example, agreements might require countries to enforce minimum wage laws or protect endangered species. By including these provisions, countries can promote sustainable development and responsible business practices. Bilateral trade agreements are common around the world. For example, the United States has agreements with countries like South Korea, Australia, and Israel. The European Union also signs bilateral deals with countries outside the bloc. Each agreement is unique, reflecting the priorities and interests of the countries involved. These examples show how bilateral agreements can be tailored to fit different economic and political contexts. Negotiating a bilateral trade agreement is a complex process. It usually starts with discussions between government officials, followed by detailed negotiations on specific issues. Both sides may need to make compromises to reach a deal. Once an agreement is reached, it often needs to be approved by each country's legislature. The negotiation process can take months or even years, depending on the complexity of the issues involved. After a bilateral trade agreement is signed, it must be implemented. This involves changing laws and regulations to match the terms of the agreement. Governments may need to train customs officials, update computer systems, or inform businesses about new rules. Effective implementation is crucial for ensuring that the agreement delivers its intended benefits. Ongoing monitoring and enforcement help keep the agreement on track. Bilateral trade agreements offer many benefits for businesses. By reducing tariffs and other barriers, they make it easier for companies to export their products. This can lead to increased sales and profits. Businesses also benefit from clearer rules and stronger protections for investments and intellectual property. These advantages can help companies grow and compete in the global marketplace. Consumers also gain from bilateral trade agreements. Lower tariffs mean that imported goods are often cheaper, giving people more choices at better prices. Increased competition can lead to higher quality products and more innovation. In some cases, agreements also ensure that products meet higher safety or environmental standards, benefiting consumers in multiple ways. Despite their benefits, bilateral trade agreements also face challenges and criticisms. Some argue that these deals can hurt domestic industries that are not ready to compete with foreign companies. Others worry that bilateral agreements might undermine larger multilateral trade systems like the World Trade Organization. There are also concerns about labor and environmental standards, especially if countries prioritize trade over these issues. Small businesses can both benefit from and be challenged by bilateral trade agreements. On one hand, they gain access to new markets and can grow their customer base. On the other hand, increased competition from foreign companies can be tough for smaller firms. Governments often provide support such as training or financial assistance to help small businesses take advantage of new opportunities. Bilateral trade agreements focus on specific sectors such as agriculture, technology, or services. These sector-specific deals address unique challenges and opportunities in those industries. For example, an agreement might reduce tariffs on agricultural products or set standards for digital trade. By targeting particular sectors, countries can promote growth in key areas of their economies. Efficient customs procedures are essential for making bilateral trade agreements work. These procedures include how goods are inspected, documented, and cleared at the border. Simplifying and harmonizing customs processes can reduce delays and costs for businesses. Many agreements include provisions to make customs more transparent and predictable, which helps companies plan their shipments and avoid unexpected problems. With the rise of the digital economy, many bilateral trade agreements now include rules for digital trade. These rules cover issues like data protection, online payments, and cross-border e-commerce. By setting clear standards, agreements help businesses operate online and reach customers in other countries. Digital trade provisions are especially important for technology companies and startups. Bilateral trade agreements don't just cover goods, they often include services as well. This means that companies can offer things like banking, insurance, or consulting in both countries. Opening up services trade can create new opportunities for businesses and professionals. It also benefits consumers by increasing competition and improving quality in service industries. Agriculture is a major focus in many bilateral trade agreements. These deals can lower tariffs on farm products, set safety standards, and address issues like subsidies. By making it easier to trade agricultural goods, agreements help farmers reach new markets and increase their incomes. However, they can also create challenges for domestic producers who must compete with imports. The manufacturing sector often benefits from bilateral trade agreements through reduced tariffs and streamlined regulations. These changes make it easier for manufacturers to export goods and source materials from abroad. As a result, companies can become more competitive and efficient. However, increased competition from foreign manufacturers can also put pressure on domestic firms to innovate and improve. Bilateral trade agreements often lead to a wider variety of consumer goods at lower prices. By reducing tariffs and other barriers, these agreements make it easier for companies to import and export products like electronics, clothing, and appliances. Consumers benefit from more choices and better deals, while businesses can reach new customers. Public opinion about bilateral trade agreements can vary widely. Some people see them as a way to boost the economy and create jobs, while others worry about job losses or negative impacts on certain industries. Governments often engage in public outreach to explain the benefits and address concerns. Understanding public perception is important for the success of any trade agreement. Technology plays a growing role in bilateral trade agreements. From digital signatures to online customs systems, technology makes it easier to implement and enforce agreements. It also opens up new areas for cooperation, such as cybersecurity and data sharing. As technology evolves, trade agreements will continue to adapt to new challenges and opportunities. It's important to distinguish between bilateral and regional trade agreements. While bilateral deals involve just two countries, regional agreements include 3 or more. Each type has its advantages and challenges. Bilateral agreements can be more flexible and tailored, while regional deals can create larger markets and more complex rules. Countries often use both types to advance their trade goals. Looking ahead, bilateral trade agreements are likely to become even more important. As global trade evolves, countries are seeking new ways to secure market access and protect their interests. Issues like digital trade, environmental protection, and labor rights will play a bigger role in future agreements. Staying informed about these trends can help businesses and consumers prepare for changes in the global economy. Keeping up with changes in bilateral trade agreements is important for businesses, consumers, and policymakers. There are many resources available, including government websites, industry associations, and news outlets. By staying informed, you can take advantage of new opportunities and prepare for potential challenges. Knowledge is key to making the most of bilateral trade. Summary: bilateral trade agreements are powerful tools for promoting trade, economic growth, and cooperation between countries. They offer many benefits but also come with challenges that need to be managed carefully. By understanding how these agreements work and staying informed about new developments, individuals and businesses can make better decisions in a rapidly changing world. Bilateral trade will continue to shape the global economy for years to come.